Good morning to you. We are going to continue discussing property, plant, and equipment. So we're going to carry on from where we finished last time. Um, and I just need to remind you, ladies and gentlemen, like we said last week, many of these notes will seem familiar because some of them were part of your uh, note, notes from Financial Accounting 1, but there are also new items here that we are going to be doing in Financial Accounting 2, and I hope to point them out to you uh, very clearly. So last time we finished talking about major inspection cost for passenger vessels like aircraft and buses and ships and trains and safety certificates. And we said that safety certificates is very similar to a major inspection, but that normally relates to rather dangerous equipment that needs to be certified as safe for the operator of that equipment. So, ladies and gents, now let us continue. We briefly spoke about impairment losses last time. So now let's have a look at it in more detail. And I have to mention here, this is also one of those items that you are going to be tested on very well in Financial Accounting 2, as well as Financial Accounting 3, in fact. So we are going to look at the basic principles of impairment losses now in Financial Accounting 2, how we account for it, how we calculate it, and so on. But the actual impairment indicator test that is mentioned there at the bottom is something that we do in Financial Accounting 3. So you'll remember last year we said that property, plant, and equipment is one of those weird topics because it is so massive that it's going to follow you throughout your student career. Okay, so let us look at an impairment loss, ladies and gentlemen. Now we already know that our normal usage or consumption, if you wish, of property, plant, and equipment is reflected as part of our depreciation expense. So we are writing down the depreciable amount, in other words, the amount that we believe that we are going to consume by using the asset over over its useful life. In fact, you may remember the definition of depreciation is that it is a systematic allocation of the depreciable amount over the useful life. So that says exactly it. But ladies and gentlemen, besides that, there can be some sort of an almost an overnight decrease in the value of an asset, some kind of damage, as we say in the notes there, right? And that sudden loss of value is then referred to as an impairment loss. And we said last week, how do we account for that? It's very similar to depreciation. We're going to debit an expense called impairment loss, and we're going to create a contra account, which is again a negative asset, very similar to accumulated depreciation, but this time we are going to call it accumulated impairment losses. We also mentioned last week, just as a reminder, that you can also combine those two contra accounts, and then you will call it accumulated depreciation and impairment losses account. Okay, be that as it may, we're going to look at many of those exercises during the course of the next few weeks. So, ladies and gentlemen, what normally happens is at regular intervals, and this is really dependent on the policy of the company. At regular intervals, it could be every year, it could be every third year, it could be every 5 years. The company will do an impairment indicator test. Now, the test itself, like I said, we are going to look at in Financial Accounting 3. So do not worry about the impairment indicator test yet. But the fact is, when we see that the impairment indicator test indicates to us that the value of the assets that we are carrying as property, plant, and equipment is in fact less than what we are carrying. So its actual value, its true value, is less than the value that we are carrying in our books of account. Then we have to write the value down. We don't want to overstate the value of our assets. That is just one of those things that accountants do. Okay, so when we get to our exercises, we're going to come back to impairment losses. Uh, then what kind of damage can we talk about? We can talk about, for instance, physical damage. For instance, if it's a motor vehicle, the motor vehicle's engine has seized up because it was driven without oil, so it could be physical damage, or it could be another kind of damage, such as for instance, economic downturn, as we mentioned there, right? So if you are in poor economic situation, we may find that the demand for our luxury goods, let's say for instance, has decreased. And therefore, the machine that we are using to produce those luxury goods might not be fully utilized. It might, in fact, the product itself might become redundant. If we are still manufacturing BlackBerry phones, nobody wants them anymore. Everyone wants the modern kind of phone. Then it means the machine that manufactures the Blackberries for us will become worthless, right? So in essence, we say depreciation. If depreciation has not systematically reduced the carrying amount of an asset to a reasonable value or a fair value, we often refer to that as, the additional loss in value should then be recognized as an impairment loss, so that we are not overstating the value of our uh, 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 property, plant, and equipment and assets in general. Now, ladies and gentlemen, this is very important to us in financial accounting too. Once again, this uh, Zicona, no, Collaborate automatically takes a register, right? If you remind me one day, I will show you the setting where it says share attendance register in the settings for Collaborate, where it states, do you want to share the attendance with Blackboard? And I click that, and then you'll see if you're 5 minutes late, you are marked absent. If you are not more than 67% of the time in the class, it marks you as absent, and so forth. Okay, so it's quite strict. But in any case, so there's no manual register. So the recoverable amount, ladies and gentlemen, that is one of the things that we must understand in financial accounting too, because that is a crucial factor in determining whether there is any impairment loss or not. So, ladies and gentlemen, it may sound a little strange at this stage, but it will become clear as we discuss this. So an asset's value, as disclosed in the statement of financial position, is clearly an estimate of the potential future economic benefits that you can expect to get from using that asset. Now, ladies and gentlemen, what is the recoverable amount? And here maybe you can take a few notes, a few of your own notes. The recoverable amount is the maximum value that that asset holds for you. In other words, the maximum future economic benefits that it can produce, right? So the recoverable amount, I'm just going to repeat that if you don't mind. So the recoverable amount is the maximum value that that asset holds for you when you are going to be using it or when you sell it. Now, when you have property, plant, and equipment, I've actually given my question away here. I've just given the answer. When you have any property, plant, and equipment, in which two ways can you get economic benefits from that asset? Perhaps you can just type a few thoughts for me, please. In other words, what are your options when you own or you have control, you have the rights over property, plant, and equipment? We could sell, thank you, Lisol. Sorry, I only noticed it now. We could sell it, exactly. So, one possibility how we can get value or get money from that asset is to actually sell it. Or like Henri says, so you're both correct now, Mr. Meshani as well. Or you can use it to gain income, right? So how can we use it to gain income? either by producing a product, ladies and gentlemen. You know those three possibilities, either by producing a product, or secondly by renting it out, like Mr. Mishane says there, or for administrative purposes. So that is part of the property, plant, and equipment definition. So, ladies and gentlemen, IAS 16 gives us the benefit here that we can use the higher of those two as our recoverable amount. So, what is the recoverable amount? And this is very important for us to know, because in some of the tests and some of the exercises that we are going to be doing, this is going to be expected of you to know. They will give you both values, and you've got to know which one of the two values you have to use as the recoverable amount. So the recoverable amount is the higher, not the lower. That is the point I want to make. We get the benefit. It's the higher of that asset's either fair value less cost of disposal. In other words, what you can sell it for. That fair value means what you can sell it for, what it is worth in the market. So if you should sell it, less any cost that you need to incur to be able to sell it. That is the one possibility. And then the other possibility is its value in use, as Enrique also mentioned there, right? So its value in use, if you continue using it as management originally intended. In other words, either for producing a product or rendering a service. You remember the three aspects in the definition, or renting it out, or for administrative purposes. Now, ladies and gentlemen, once you have determined the recoverable amount, which is the higher of the fair value, what you can sell it for, less any cost you need to incur to be able to sell it, or its value in use, what do you have to compare the recoverable amount with to determine whether there is an impairment loss or not? What do you have to go and compare the recoverable amount with? Obviously, the value in our books. And what do we call that? Chartered accountant. No, we don't call it chartered accountant, but it's also CA. Sorry for that lame joke. Also CA. The carrying value. Thank you, Mr. Mbazini. Absolutely. Or thank you, Angel. The book value, or the carrying value, or the carrying amount. We often refer to the CA as the carrying amount. So, ladies and gentlemen, what happens here? If your recoverable amount is more than the carrying amount, are our assets then overvalued or not? Just a yes or no, please. If the recoverable amount is more than the carrying amount, are we carrying pie in the sky, an inflated value? Looks like you're a bit wary to answer that one. If our recoverable amount exceeds or is more than our carrying value that we are carrying in our books, ladies and gentlemen, it means we are not carrying an inflated value for our property, plant, and equipment. In fact, it is more, it is actually worth more if either we sell it or we continue using it than the actual carrying amount that we are carrying. So in that particular circumstances, should we account for an impairment loss? Yes or no? No, thank you, Mr. Mbazini. Quite correct. The answer there is no. You are not carrying an inflated value, so you simply leave your carrying amount as it is. We are not going to go and reverse any of our depreciations. In fact, IAS 16 prohibits the reversal of depreciation. You are allowed to in the future reverse impairment losses, but not your systematic depreciation. So in that case, ladies and gentlemen, we simply leave it as it is. Now let's look at the opposite situation. If your recoverable amount, in other words, what it's really worth to you, if either you sell it or you continue using it, if that recoverable amount is less than the carrying amount or your carrying value or your book value, however you want to describe it, in, in fact, the balance in your ledger for that kind of asset, are we then carrying an inflated value in our books of account? Yes or no? Yes, thank you, Mr. Mbazini. Right. Then we are carrying an inflated value. We often joke, and I've mentioned this. Thank you, Enrique. Um, um, that you are then really carrying pie in the sky. You are carrying a value that you cannot recover either from selling it or from continue using it. Right. So in that particular case, ladies and gentlemen, we have to account for an impairment loss. So then we are going to look at the difference between our RA or recoverable amount and our CA or carrying amount. And only in that case are we going to write down an impairment loss. So we're going to debit our impairment loss expense account, and we are going to credit our accumulated impairment losses, or if you are using the combined account, accumulated depreciation and impairment losses account. Okay, so that needs to be done every time when we do an impairment test. Enrique asks, will there be a point where they are equal, sir? It is quite possible. Look, it is probably not very likely that when you do an economic indicator test and then you compare it with your carrying amount, that they will be exactly equal. So the odds are very low, but it is not impossible. But in such a case, if it should happen that they are completely and totally equal, then once again it means you are not carrying pie in the sky. You are not carrying an inflated value. In fact, your value that you are then disclosing for your property, plant, and equipment is basically 100% accurate. What is the term that they use in auditing? Your valuation is then 100% spot on. Right. So I hope that answers it, Enrique. So if it's exactly equal, it also means you are not going to recognize it or going to record an impairment loss. You will in fact be overjoyed that your depreciation has been so accurately calculated over the years. Okay, again, when we get to our exercises, we are going to cover that a little bit. Well, not a little bit, a lot further. Right. So yeah, we just mention again that the impairment of an asset. Well, the impairment we are doing now, but the economic indicator review, where you are going to be determining the value in use, and where you are going to be determining the fair value less cost to sell, that we do in financial accounting 3. So maybe I can just maybe make this a little bit clearer, ladies and gentlemen, just in case I've confused you. So what we are saying in financial accounting 3, you are going to do that economic indicator test, right? Which means you are going to calculate the fair value of that asset, and you are going to estimate the cost of disposal. Also in financial accounting 3, you are going to use various economic indicator tests, even the share value of the company and so forth, to determine the value in use. So that we are not doing in financial accounting 2. What we are doing in financial accounting 2 is that you should know which one of those figures to use once you have calculated it, right? Clearly, it's the higher of the two, right? The higher of which two? Fair value less cost of disposal or cost to sell, or its value in use. And then you must know that you must compare that, or first of all, then you must know that you can use the higher of those as your recoverable amount. And then you should know that you've got to compare your recoverable amount with your carrying amount. And if the recoverable amount is more than the carrying amount, you do nothing further. You do no adjustment. But when the recoverable amount is less, lower than your carrying amount, then you've got to recognize an impairment loss. So that is the difference between financial accounting 1 and financial accounting financial accounting 2 and financial accounting 3. We are going to do all the uh, 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 accounting entries for an impairment loss, but how to arrive at those two figures we do in financial accounting 3. I hope that is quite clear now. Right, ladies and gentlemen, and here we just, in a little sentence, just confirm what we've just said, that we only impair the asset. In other words, we only recognize an impairment loss if the carrying value or carrying amount is more than the recoverable amount, right? Because clearly then you are carrying an inflated value. Then, ladies and gentlemen, I think this we've also mentioned in financial accounting 1, so we're not going to spend too much time on it. IAS 16 provides us with two models that we can use to value for the valuation of our property, plant, and equipment: the cost model and the revaluation model. Now, the revaluation model is discussed at length in in the advanced diploma in general financial reporting 4. So we are mostly going to focus on the cost model. We are going to focus on the cost model. So we are going to use the cost of the asset as the basis of the valuation of the asset. However, I've got to warn you, there are a few exceptions, but they are very straightforward. They are not as complicated as the ones you'll encounter in general financial reporting 4. But we will see that in certain of our exercises, and might even get that in a test, that they say all of the assets are using the cost model except for, let's say, land. And land is using the revaluation model. Now that has got a few little implications for us, ladies and gentlemen. The first implication is when we have to draw up our accounting policy notes for property, plant, and equipment, we've got to disclose exactly that. So in our accounting policy, we will be saying something like the company uses the cost model for all its non-current assets or for all its property, plant, and equipment, depending on the situation, except for land where the revaluation model is used. That is the one implication. The other implication, you remember the property, plant, and equipment note, not the policy note, the note itself, where we go and distinguish between the cost and the accumulated depreciation at the beginning of the year, and we then reconcile it to the cost and the accumulated depreciation at the end of the year. So there, obviously, when you get to one that is using the revaluation model, you cannot say land at cost. You will have to say land at revaluation, right? You will even call your general ledger account land at valuation, not land at cost, land at valuation. Then also, it is possible if a revaluation has occurred during the course of that specific financial year, that revaluation will form a reconciling item. You remember at the beginning of the year when we did IAS 1, we've already discussed this. So this is not completely new to you. You know that one of the components of other comprehensive income, in other words, right at the bottom of our statement of comprehensive income, one of the components, one of those that are not allowed to be what's the word that I can't think of now? Reclassified, that's not allowed to be reclassified to profit or loss, is indeed an increase in the revaluation surplus or an increase in the revaluation reserve of an asset that is being valued on the revaluation model. But for all other purposes, we will be using the cost model. Right, let's see, ladies and gentlemen. This we have done in financial accounting one. So the next number of pages is really just revision. So you can go through them. You know what a useful life is. You know what depreciation is. Uh, well, yes. Uh, a change of an accounting estimate we are only doing in financial accounting 3. I'm just mentioning here that if the use, in fact, if any, not only the life, if any of the factors or any of the components of depreciation should change. What are the components of depreciation? There are 3 of them. The method of depreciation. The second one is our residual value. And the third one is our useful life. So if any of them should change during the course of the year, we will account for that as a change in an accounting estimate. Now, like I said, I'm just mentioning this. We will only do that in financial accounting 3. The method that we use is referred to as the reallocation method. So then we are going to, instead of using the original cost of the asset, we are going to use its carrying amount at the beginning of the year as its depreciable amount. But anyway, I've said too much already because we're only doing that in financial accounting 3. But we need you just to be aware that those estimates, your method of depreciation, your useful life, your residual value, they are not cast in stone. If there is a valid and a solid reason for that to change during the course of you using the asset, it can be done. It can be done, and then we simply account for it as what we refer to as a change in estimate. Okay, then this is all revision, ladies and gentlemen. The next number of pages is just to refresh you. When do we start the depreciation process? When do we start the depreciation process? Well, we can look at that in 2 ways. We can look at that in 2 ways. Depreciation begins, either you can say when you have stopped, when you have stopped accumulating any costs on it. In other words, that asset is now in perfect condition so that it can be used as management intends. In other words, everything is done, it's been installed, it's been inspected. What does that imply? It means the asset is now available for use. That is what we've mentioned there. Right, so let us just go through those 3 examples or 3 scenarios that we did in financial accounting 1, just to make this clear, because there are going to be some tricky little test questions here and there that is going to test whether you know this. So, and I know there's one exercise, or at least one, probably more than one. I'm just thinking of one specific one where this is also tested. So let's say you purchase a machine on the 1st of January, right? You purchase the machine on the 1st of January, but during the course of the month of January, the engineers will be installing the machine in your plant or in your factory. You are still incurring various costs. You are testing the machine whether it's actually properly functioning. So it is not quite the finished product yet. And then at the end of January, let's say on the 31st of January, you see, okay, everything is now fine and dandy. Everything is working. It has been properly installed. From tomorrow, the 1st of February, we are going to make this available for use in the factory, right? So we bought it on the 1st of January. It is ready to be used. That's another way you can describe it. Not only can you say available for use, but ready for use. So it's ready for use on the 1st of February. But then we've got a taxi strike that lasts a month, let's say. I'm touch wood. Hopefully everything will be sorted very soon. Anyway, So now we cannot start using it. We only actually start using that machine on the 1st of March. So we've got 3 dates there. The purchase date is the 1st of January. It became available on the 1st of February for use. And on the 1st of March, we started using it. So on which of those 3 dates will we actually start our depreciation process? If you can type for us an answer there, on which of those 3 dates will we actually start our depreciation process? 1st of February. Thank you, Mr. Bazini. Spot on. The 1st of February, the day when it was ready for use or when it became available for use. Then we start the depreciation process. There is one little exception to that rule, but we are not dealing with that in financial accounting too. The exception, I might just mention that, is if you are using the usage method. If you are using the usage method of depreciation, then obviously only when you use it will depreciation be calculated. Sir, can you recognize minor damages when the asset is installed, for example, as depreciation, since it decreases the asset's value, or is it an impairment loss? Enrique, what will happen in that case? Thank you for that question. It is an important question. What will happen in that case? It is not going to be recognized as a loss whatsoever. So if you've got minor damages while the asset is being installed or at any point in time before the asset is ready to use, remember now you haven't started the depreciation process yet. You are only going to start the depreciation process once the asset is ready for use. So what will happen with those losses if you are not going to write it off? Let's see if somebody can answer that for us. So if we have those damages while we are still in the process of preparing this asset to be ready, what will happen to those damages and those losses that we incur? Remember, losses and damages, they are debits. What are we going to do with them? I know this is a hard question to answer, but we are going to capitalize it as part of the cost of the asset. As simple as that, Enrique and everybody else. So if you incur some sort of a cost or some sort of damage of 1,000 rands and the asset is not available for use yet, you are simply going to add that 1,000 rands to the cost of the asset, right? So it will increase the cost of the asset, any damages that you incur before it's ready for use. So only when it becomes available for use, if there are subsequent damage, then you are going to account for that as an impairment loss, right? So your depreciation as well as any possible impairment losses only start once that asset is fully ready to be used. Until such time as it's ready to be used, any cost that you incur will be capitalized as part of the cost of the asset. Any incidental, we will also see this is a possibility later when we get to our exercises. And then even here in our notes, we'll see that later. If you have any incidental income during the course of testing it, that will decrease the cost of the asset. You are not going to recognize it as income, but rather use it to decrease the cost of the asset. So it works both ways. Right. Okay, there that same scenario is explained. So we've all done this. Okay, that assets held for sale, ladies and gentlemen. That paragraph really belongs to financial accounting 3. We just mentioned that if an entity is going to change their type of business, let's say for instance, this is a business that rents out motor vehicles, right? So their whole business is renting out motor vehicles, and then suddenly one day they decide that they are no longer going to rent out motor vehicles. They are going to sell it. They are going to go into the motor trade. They're going to buy and sell motor vehicles at a profit. What happens then with their fleet of current motor vehicles? Now it is not for rental anymore because they are going to sell it as part of their inventory. So it will be transferred from motor vehicles, which is a non-current assets, to assets held for sale, which is then a current asset, and then the motor vehicle, whatever the asset is not further depreciated. Okay. But anyway, like I say, that will be discussed in depth in Financial Accounting 3. Uh, Depreciation then obviously ends as soon as, well, this is the default, as soon as the asset is derecognized. When is an asset derecognized? Either when it becomes useless for us or worthless to us, or when we sell it. So we are only derecognizing an asset if we either sell it or if it has no future economic benefits for us, so it has become worthless. We also derecognize it. We take it out of motor vehicles if we are intending to trade in it, right? So we're going to use it not to rent it out anymore, but to trade with it. Then we transfer it from the non-current asset to a current asset. So it's basically, it becomes part of your inventory, right? Um, Leases, ladies and gentlemen. Okay. I'm not too sure how much we should discuss about this because leases is also a Financial Accounting 3 topic. I'm not sure why I didn't take this paragraph out, to be perfectly honest. But anyway, when we get to Financial Accounting 3, we'll see when when we have something we call the finance lease. It means that the company, even though the company is not the legal owner of the asset, the company has got the right of use. Um, do you want me to go into details about that or not? You can just say yes or no for me because it's not necessary for financial accounting too. But if there's somebody who wants to know how it works, then I'm totally prepared to go through it. Yes, you want to know. Okay, Henri. So, ladies and gentlemen, whatever I'm going to say in the next few minutes is really for Financial Accounting 3. You won't get that in Financial Accounting 2, but I just want to say it because there are students who are interested in very interested in how accounting works. So when there's a finance lease, let's maybe just talk about a normal purchase, a normal acquisition. If there's a normal acquisition of a motor, let's use a motor vehicle so that we can get, so that we keep a little asset in mind. So here we've got a motor vehicle, but it can be any kind of property, plant, and equipment, right? We go to the motor car dealer and we say, right, I want to buy this motor vehicle, right? What do? You capitalize the acquisition. In other words, you debit your motor vehicles at cost. And if you pay cash for it, you're going to credit your bank. Or if you are going to pay it, let's say at the end of the month or at the end of next month, you are going to credit your accounts payable. That is straightforward. So there are only two parties involved. You can see there are only two parties involved. It's the supplier of the vehicle and your company as the user of that vehicle. When it comes to a finance lease, there are actually three parties involved. There are three parties involved. The same two parties, you as a business or you as a company that's going to be using the vehicle, the supplier of the motor vehicle, but then the third party is a financing institution such as a bank. So you have gone to the bank or you've gone to some, let's say, some financing institution. I can't think of any name now. What is Nedbank's one called? Net something. Anyway, so you go to a financing institution and you say, I want to buy that delivery truck or motor vehicle for 1 million rands, but I haven't got 1 million rands, and I'm don't think I'm going to have 1 million rands within the next couple of months. So I want you to finance the purchase of that motor vehicle for me in a way that I can afford it. So what happens in that case, ladies and gentlemen? The bank, if they agree to you as a customer, they will pay the 1 million rands to the supplier of the motor vehicle. So they will pay cash for it, right? So it's done, it's dusted, it's been fully paid from the perspective of the supplier of the motor vehicle. But, ladies and gentlemen, even though the bank has paid it in full, who's going to use the motor vehicle? The bank or us? You can type for us. Is the bank going to use it or are we going to use it? Us. Thank you, Mr. Mbazini. Thank you, us. Thank you, Enrique. Thank you, Kulare. Okay, so we are going to be using it, not the bank, right? So, ladies and gentlemen, it means we. Now, there are many aspects here. That is why I was a bit worried to start this discussion. So, first of all, from our perspective, we've got all the rights of use. We've got all the rights. Remember, rights. The right is part of the asset definition. We've got all the rights to the asset. We can use it as we choose. We can use it as a director's vehicle. We can use it as a delivery vehicle. We can use it as we wish because we've got all the rights of use. We've got similar rights as if we are the owner of the motor vehicle, even though we are not yet the owner of the motor vehicle until such time as we've fully repaid the bank. So, what does the bank get out of this deal? What the bank or the financing institution gets out of this finance lease agreement, ladies and gentlemen, is they hit you with interest. That is their income, right? As you know, thank you, Kolani. I see you've also given us there. So they are going to say, right, that 1 million rands that we've paid on your behalf, we're going to now add 800,000 rands worth of interest on it, right? So you've got to pay us over 5 years in installments, monthly installments. Every month you've got to pay us, let's say, 20,000 rands or whatever the case may be. We can do those calculations on our financial calculators. So they're going to say you are paying us a monthly installment. So now it is affordable for you. You can now afford to purchase that because we have paid the full amount, but you are repaying it as over 5 years in monthly little installments of 15 or 20 or whatever thousand rands, right? But included in that will be then the 1 million rands capital and another, let's say, 800,000 or even more of interest. And that is the bank's income then, right? Okay, so the fact is, ladies and gentlemen, to cut this has now really been a long story, longer than it should have been. But anyway, to cut that long story short, from an accounting perspective, you are going to treat that asset, that motor vehicle, in exactly the same way as you treat your property, plant, and equipment that you actually own. The only difference is you are going to call it capitalized leased assets. Capitalized leased assets. Leased, in other words, LEASED, capitalized leased assets. So it is, we're not the owner yet. We only become the owner once we've fully paid the bank, but we've got all the rights and privileges of ownership. Which means, in turn, ladies and gentlemen, we are going to depreciate it just like we do all our other assets. That is the point here, right? So, because we are treating it similar to our own property, we are going to also depreciate it in exactly the way that we do our own property. I hope now you've got a whole financial accounting 3 lesson behind you. Okay, this also comes from Financial Accounting 1 already, so we're not going to spend too much time on this. This is identical. This you will recognize immediately. This you can go through on your own. This is exactly the same as in your Financial Accounting 1 notes. However, years an exception, I think. Let me just see now. That's all coming from our Financial Accounting 1 notes. Okay, here we now start with the new stuff again, right? So those up to page 16 is basically the same as you had in financial accounting 1. Now we get to some new stuff again, ladies and gentlemen. Let's just pause there for a few seconds. I've been talking non-stop. Are there any questions from your side at this stage? Doesn't seem to be, and I'm sure if there were, then you would have typed it already. Okay. So now we are going to look at the matter of an asset exchange. And this, ladies and gentlemen, is a long story. So I'm going to spend most of the rest of this class on asset exchanges because I really need you to understand this, because it's going to count a lot of marks in your class test. It's going to count quite a lot of marks in your formal test. So we have to understand an asset exchange. By the way, an asset exchange is often also referred to as an asset swap. So you can maybe just make a little note there. If you ever encounter the term asset swap, it is the same as an asset exchange. And we're going to look at an example of a typical asset exchange in the next few minutes. So let us first talk about what is an asset exchange. Now, ladies and gentlemen, we all know that there are various ways in which we can acquire an asset. Now, I'm not even referring to a lease. I'm talking about the actual purchase. So if we acquire property, plant, and equipment, and we pay for it immediately, we pay for it out of our bank account, then we know we're going to debit the asset at cost. Say it's vehicles at cost, vehicles colon cost, we're going to credit bank. If we buy it on credit, we are still going to debit, let's say, vehicle colon cost, if it's a vehicle or whatever that category of asset is, but then we are going to credit creditors or accounts payable, if you wish. But, ladies and gentlemen, there is a further possibility. Besides using credit facilities, of the supplier of the asset, and besides paying cash for it, we can also use another asset of ours, an asset that we already own, as a partial payment for that new asset. That is what is called an asset exchange. So not only are we using credit facilities, not only are we using cash or money to pay for the asset, but we are also using another kind of asset than cash to use as payment, or at least partial payment, for purchasing the new asset. Now let's think about a typical example, ladies and gentlemen. Let's think about a typical example. Let's say, while we are talking vehicles, let's stay with vehicles. So let's say you want to buy a new vehicle. There's a nice, shiny new vehicle on the floor of a dealer. They deal in new as well as second-hand motor vehicles. This is a brand new model, and your heart thumps every time you see that vehicle. You want it. Okay. So you are going to go and buy that vehicle. But you are going to replace your old vehicle. You're not going to keep your old vehicle. So let's say that new vehicle costs 200,000 rands, right? So you go to the dealer and they say, or there's a poster or a sign on the motor vehicle that says this is the cost of this vehicle is 200,000. So you go to that dealer and say, I want to buy this vehicle, right? I am your man today, or I am your lady today. You are going to sell this to me. And then you also say, oh, by the way, I want to use my old car as a trade in. I want to use my old car as a trade in because I'm a single person. I'm not going to, I've got no use for two cars. So I'm just going to want to use my old car as a trade in. So then that motor dealer will go and inspect your car, and that motor dealer will say, will think for himself or herself, I can sell this car for, let's say, 60,000 rands. I can sell this car for 60,000 rands. I'm going to offer this person that wants to buy the new car a trade-in of 50,000 rands because, you know, they've got to make their cut as well, right? As always. So they're going to offer you 50,000 rands for your old vehicle. So, ladies and gentlemen, what happens in that case? Now, if you can type a few answers for me here. In that particular case, now I know this is a private person and we're talking businesses really, so we're going to look at the accounting procedures for a business later on, but this is just to get the idea. So, what is that new vehicle worth to us? What is the cost? What are we going to capitalize as the cost of the new vehicle in that example? Nice try, Mr. Mbazini. I've been spot on most every single time. Thank you, Kolani. No, the fact is the actual cost of the vehicle is 200,000 rands, right? And that is why we're having this discussion before we go and look at any of our exercises. The actual cost of that vehicle is 200,000 rand. So it means its fair value is not 150,000. Its fair value is 200,000 rands, right? But now we are giving up our old motor vehicle. We'll see we are using the term giving up a lot here. It's also used in your textbook. We are giving up the old vehicle, and how much are we getting? How much in value are we getting for the old vehicle? How much in value are we receiving from that motor dealer for our old vehicle? 50,000. Thank you, Mr. Mbazini. Quite spot on, right? So we are receiving value of 50,000 rands. So how much must we still pay in cash for that new vehicle? How much must we still pay as a top-up payment? We must still go and pay that dealer 150,000. Thank you, Mr. Thank you, Mr. Mbazini, as well as Enrique. There we go. Okay, so you get the idea, ladies and gentlemen. We are buying an asset with a cost of 200,000 rands, but we are really making two payments. We're not only making one payment, we are making two payments. We are using the value of our old motor vehicle as a partial payment for the new vehicle. And then we have to also pay in a further 150,000 rands, right? So that means the cost of the new vehicle is still 200,000 rands. We'll see that we have to calculate possible profits and losses later on when it becomes a little bit more tricky. But we'll get there. We'll get there soon. But the fact is that we've got to sort of get our heads around, ladies and gentlemen, is that there are certain processes and certain steps from an accounting perspective that we've got to go and complete when we are recording an asset exchange. Now, I hope you've got pen or pencil and paper with you because I want you to take a few notes here. I could have typed it in the notes, but I haven't. So I'm afraid you'll have to take it yourself. I'll give you 30 seconds or so, maybe just to gather a paper and pen if you haven't already. Okay, so really, in effect, ladies and gentlemen, well, let's assume our depreciation on our old motor vehicle. Now we're not a private person anymore; we're now a business. So our depreciation on our motor vehicle is up to date because that is the first thing that you must ensure is that your depreciation is up to date until the very day that you are going to use it as a trade-in. So a trade-in, by the way, if I haven't mentioned it already, a trade-in is a typical example of an asset exchange. It is an obvious example of an asset exchange, one that we encounter every single day, hundreds, if not thousands of. So there are basically 4 steps when we are going to record an asset exchange. Now, that's more than half a minute that I've wasted time. So you should all have your pens and pencils and paper and notebooks ready. One of the steps, it doesn't really matter in which order you do it. So I'm going to say step 1, step 2, and step 3, but it doesn't necessarily have to be in that order. It can be in a different order. The first, or one of the steps, you understand what I'm saying? I'm going to say first, second, third, and so on, but it doesn't have to be in that order. But anyway, one of your steps, the first one, let's call it the first one, is that you've got to capitalize or recognize. You can put down both words there. You've got to capitalize or recognize the new asset, which means we've got to determine a value for it. How we are going to do that, we'll see in a few minutes' time, because there are many options and we're going to discuss all of them. So our first step is to capitalize or recognize the new asset. In our little example, it means we are going to debit motor vehicles, cost with 200,000 rands. Right. Our second step, ladies and gentlemen, and like I say, it doesn't matter which order you do them in. Our second step, maybe you can type for me there. If we say we've got to recognize the new vehicle, what do you think will be another step? Let's see if someone can type for me there. I'm now very curious, George, curious to see whether you can figure out what will be one of the other steps. Yes. Sorry for shouting. Sorry for shouting. Sorry. My apologies. I was just so excited there. Thank you, Henrique. You've got to de-recognize the old asset. Yes. Me too. I can. The tears are rolling from laughter. Exactly, ladies and gentlemen. You are buying a new car, but at the same time, you are selling or using your old car as a trade-in. So you're no longer going to own it. So your second step is to de-recognize the old asset. Now, ladies and gentlemen, when we de-recognize an asset such as property, plant, and equipment, we know that we do not have an account, a ledger account called motor vehicles at carrying amount. But we've got 2 or 3 accounts that does represent the carrying amount, right? So we've got the cost of that old motor vehicle in one account, the account called motor vehicles cost, and we've got the accumulated depreciation that we've written off over the last number of years that we've owned that motor vehicle or used that motor vehicle in another account, right? So, ladies and gentlemen, what we need to do if we are going to de-recognize the old asset, let me ask a few questions. The old asset, right? The old motor vehicle, the one that we're going to use as a trade-in. Its cost, will that be on the debit side of the cost of the vehicle's cost account or on the credit side? The cost of the asset. We've just seen that we are going to debit vehicles cost with a new vehicle. We would have done the same when we bought that old motor vehicle that we're going to use as a trade-in. So the cost of the old vehicle will also be in that very same account called motor vehicles cost. But now we've got to go and take it out of that account. So it means now what do we have to go and do with that whatever the cost of the old motor vehicle was, we've got to go and credit the vehicles cost account. We also know, and this is still part of the derecognition process, we also know that the contra account, the negative asset, which we refer to as accumulated depreciation or accumulated depreciation and impairment losses, that will have a credit balance because it's a contra to the cost. So we must go and take out the accumulated depreciation that we've written off until the day that we are using this motor vehicle for as a partial payment, as a trade-in, out of that account. So it means because it has a credit balance, we now need to go and debit motor vehicles colon accumulated depreciation. Right. So those are our first two steps. Recognize the new asset, de-recognize the old asset. Our third step, ladies and gentlemen, we've seen that in our little example that we've sucked out of our thumb a little while ago, that we had to pay in 150,000 rand. So our third step in this process of recording an asset exchange is to record this. You must take a note again, please. You must record the movement of money. You must record the movement of money. How do we record the movement of money? In our example, we paid money. We paid money. So if we pay money in on the deal, are we going to credit or debit our bank account? If you can type for me, please. Credit. If we are going to pay it, thank you very much. Both Enrique and Mr. Mbazini, thank you. So if we are making payment from our bank account, we are going to credit the bank account. So we would have recorded that 150,000 rands as credit bank. If we are receiving money during this deal, if for some reason our old asset is worth more than the new asset, which is not impossible, sometimes we may swap or exchange different kinds of assets. So if during this process, if we are receiving money, then clearly it means, thank you, Mr. Aimbana, as well. It means then we are going to debit the bank account, right? Then we are going to debit the bank account when if we should receive money. So that's our third step: record the flow of money. Now, there's the fourth step, ladies and gentlemen, is calculate the profit or loss on the exchange of assets. So our fourth step is to calculate and record, I should say. Calculate and record any profit or loss on the exchange of asset. We are going to call that account, in fact, either profit on exchange of assets or loss on exchange of assets. Tiffany, step 3 is record the movement of money. Step 3 is to record the movement of money. So if you are paying in on the deal, you have to pay an additional amount. It means you have to credit your bank account in that same entry. If you are going to receive money during the course of this transaction, this deal, it means you have to debit your bank account. So the third step, or whichever number you call it, is simply to record the movement of any payment that was made. You're most welcome, Tiffany. And then our final step, our fourth and final step, is to calculate and record either a loss or a profit on exchange of assets. Now, ladies and gentlemen, that is simply our balancing figure. Whether we are recording this in a journal, which we should record it in a general journal first, or whether we are doing our asset exchange ledger account, doesn't matter. The fact remains, it will simply be our balancing figure. So to make that journal entry, let's use a journal entry, our books of initial entry, a general journal. So the balancing figure, you've got the acquisition now on the debit side, you've got the disposal, the cost on the credit side, and the accumulated depreciation on the debit side. You've got the movement or the payment of money on either the debit or credit side. Now, if that journal entry does not balance, if your debits are not adding up to the same figure as your credits, it means you have made either a profit or a loss on this exchange of assets. Okay, so the fourth step, I hope that one is now also clear, is simply to balance your journal entry. Now, let me just test you again a little bit here. If you need a credit in that journal entry, if you need a credit to make it balance, does that then represent a profit or a loss on the exchange of assets? If you need a credit to make the journal balance, would that represent a profit or a loss on exchange of assets? Ooh, I'm testing you this morning. Nice try, Mr. Mbazini. Like I said, you were right almost every time. But ladies and gentlemen, remember, incomes and profits are always credits. Thank you, Enrique. Remember, incomes and profits are always credits. Losses and expenses are always debits. So if you need a credit in your journal to make it balance, it means it is a profit on the exchange of assets. If you need a debit in the journal, I know that in the ledger, in the general ledger account, which we call the asset exchange account, it works the other way around, because that indicates the contrast. We'll do an exercise about that in probably about a week or two's time. Anyway, we are talking general journal now, right? If you need a debit to make your general journal entry balance so that your debits and your credits, the totals equal one another, then it means it's a loss on exchange of assets. Okay, ladies and gentlemen, now let us just go through some of these notes, but there's actually another discussion I wanted to take up with you. We say here that items of property, plant, and equipment could be acquired by an exchange of a non-monetary asset or a combination of the two, like in our example, right? For example, an entity could acquire a machine, and in exchange for the machine, the entity gives one of its vehicles up as a full, either a full payment or a partial payment. Now, the exchange could result in an asset being given up, and as well as an asset and cash could be given up. Or, ladies and gentlemen, as we've seen, an asset could be given up and cash could be received. Right. Now, ladies and gentlemen, this is now everything that you thought was difficult up till now was actually very easy. Now comes the difficult one. I'm pulling your legs, right? I'm just messing with you. I'm just messing with you. I just want us to go through the thought processes of how we determine the cost of the vehicle that we are acquiring. How do we determine the cost of the vehicle that we are acquiring, or any other asset, any other piece of property, plant, and equipment? You remember this from financial accounting one, where we simply acquired, without an asset exchange, where we simply acquired property, plant, and equipment. How do we determine the purchase price of any property, plant, and equipment? How do we determine the purchase price? There are three possibilities. You remember, there are three possibilities. What are they again? I'm going to repeat them. You don't need to type them. There are three possibilities that make up your cost. First of all, your purchase price. Your purchase price. You remember that. Secondly, it is directly attributable cost. We've gone through that last week, if I remember correctly. Directly attributable cost. So that is any item, any cost that is necessary or that is necessarily incurred to bring that asset to a location or condition where it can be used as management intends, right? And the third possibility, as you remember, the one that we encountered in financial accounting too, is certain future costs. Certain future costs. So when it comes to the purchase price, and by the way, it is highly unlikely that in an asset exchange question that they will include directly attributable cost or certain future costs. It will normally only be the purchase price, right? So I can give you a little heads up there. So how did we say earlier, well, last year and as well as last week, how do we determine the purchase price? What is our default? What is our first port of call, our first method to determine the purchase price of an item of property, plant, and equipment? If somebody can type for us, I just want to see whether we are still on the same page. As a default, how do we determine the purchase price of a new asset? By what we pay for it. Either today, if we should pay today, or what we are going to pay for it, let's say in 2 months' time, right? So your purchase price is determined by what you pay for it. So, ladies and gentlemen, if we go back to our little example that we had a little bit earlier about the 200,000 rands new vehicle, and we get a trade-in of 50,000 rands, and we have to pay in 150,000 rands, we can clearly see that how did we determine the purchase price of the new vehicle? Yes, I know we've said this, that there's a banner or a sticker on the car that says it has a cost of 200,000 rands. But that is not the argument I want us to use, because now we have to go and look at it from a different perspective. We must go and look at the perspective of what did we pay? What did we actually pay for that new motor vehicle? What did we pay for the motor vehicle? And that then determines our cost of the new vehicle. There are some exceptions. We'll get to the exceptions. What's the time now? Yes, we'll still get to it today. So there are some exceptions. But this is your default situation. The first thing that you must consider before any other factors are considered is what did we pay for that new motor vehicle? So if you can type for us, ladies and gentlemen, what did we pay for that new motor vehicle? And this, I have to warn you, is a trick question. It's not as obvious as it seems. It is a trick question. I've scared everyone off from answering. What did we pay for that new motor vehicle? Okay, I'm afraid I've put you off now with the saying it's a trick question. It is a bit of a trick question, but we paid, ladies and gentlemen, 200,000 rands for it. Its cost was marked as 200,000 rands, and how much did we pay for it? Exactly that. We paid 200,000 for it, but we made two payments. We did not only make one payment; we made two payments. The one payment was by using the fair value of our old vehicle as a payment. That dealer was prepared to give us 50,000 rands. Now, what they don't do, they don't pay you the 50,000 rands and then you pay them the 50,000 rands back. They simply take your vehicle and give you credit of 50,000, right? To make the two payments will just be rubbish. That will be illogical. So they give you the value, the fair value, what they deem to be the fair value or the trade-in value of your vehicle as a credit, but you have used that vehicle as a partial payment of 50,000 rands. So that was your first payment already. You've paid 50,000 rands by using the fair value of your old vehicle. And then you paid a further 150,000 rands cash or from your bank account, right? So, what did you pay in total for that motor vehicle? Now you should all be able to answer it. In total, we paid 200,000 rands. Thank you, thank you, Enrique. Thank you, Mr. Mbazini. You guys are very awake. Thank you. Right, so we can now see we paid 200,000 rands for it. However, ladies and gentlemen, okay, so let us just complete this argument. So our default, our normal first port of call, how we determine the cost of any new item of property, plant, and equipment is by determining its purchase price. And how do we determine its purchase price? By seeing how much we paid for it. So, ladies and gentlemen, now this is also a little bit of a trick question. A little bit of a trick question. Let's say that motor vehicle wasn't marked 200,000 rands, right? We could go and negotiate a price. So it wasn't specifically marked 200,000 rands. Then how would we have determined that we have bought it for, or that its cost is 200,000? As we've just said, we would have looked at how much did we pay for it. We paid for it by using our old vehicle, and we also topped it up with cash. So now my trick question, ladies and gentlemen. If we are purchasing a new asset and we use an old asset as an exchange as partial payment, what are we going to use as part of our purchase price? The fair value of the new vehicle or new asset that we are buying to determine the purchase price, or the fair value of our old vehicle or old asset that we are giving up? Now, I want you to type something for me there. Don't be scared if it's wrong. Don't worry. Give it a shot. If you think about that whole scenario that we've just spoken about, in determining the purchase price of that new asset, we've got a difference of opinion, Enrique and Mr. Mbazini. I'm not going to say which is which so that it gets recorded, but we've got a difference of opinion. Ladies and gentlemen, which one of them is correct? Like I say, I'm not going to mention the name who's wrong or who's correct because that we don't want it as part of the recording. But how did we determine the purchase price? Mr. A.M. Mbana, you're also a very good answer there. Thank you, Mr. Mbana. Right, ladies and gentlemen, if we looked at that scenario that we had a little bit earlier, we took the fair value of the old asset. So clearly, those that answered the old asset, fair value of the old asset, they are correct, right? So we use the fair value of the old asset plus the actual value of our cash to determine the purchase price of that new vehicle. So that is our default method. So, ladies and gentlemen, if you've got that clear in your minds, then we've achieved a lot today already, and I can see most of you have. Okay, so our default method, let me sum it up one last time. Our default or first port of call method is to use the fair value of the old asset to determine the purchase price, because that determines how much we are paying for the new asset, right? Because we are paying with the fair value of the old asset plus we are paying with cash. However, ladies and gentlemen, there are a few exceptions to that rule. Let us discuss the two exceptions. And I'm going to take the easier one first. The other one is going to be a little bit longer explanation or a longer discussion, if I can put it that way. What is the case if your asset that you are giving up, your motor vehicle, let's say it's not a standard motor vehicle, you don't find it in the Auto Trader booklet. Let's say it's a dune buggy. You bought some years ago. You bought a Volkswagen Beetle chassis and a Volkswagen Beetle engine, and you quite handy. And over the years, you've built with what do they call it? Something glass, fiberglass, with fiberglass and all sorts of ingredients. You've manufactured this unique vehicle. There's no other one like it. Ladies and gentlemen, that means you are not going to know what the fair value of your vehicle, your old vehicle, is. So what IAS 16 carries on with, they go further. They say even though we've discussed the default method, where the fair value of the old asset will be used to determine the purchase new asset plus or minus Can you hear me now, students? Can you hear me now? Can you hear me now? Okay, Henrik, thank you. It's something to do with this connection. Thank you, Angel. Thank you, Aluve. Okay, so now you can hear me again. Thank you. And well, let me just repeat. I'm not going to say the whole story again, but let me just basically sum up what I've been saying. I was just apologizing. The internet has been coming and going today. It's very strange. I know that I'm pretty sure I can blame ESCOM for it, that they're destroying our routers. But in any case, it is sorted out now. Hopefully it lasts, but we're almost done in any case. So, ladies and gentlemen, if we do not know what the fair value of the asset that we are giving up, and if we say the asset that we are giving up, it means the one that we are using as a trade-in, that we are going to use as a partial payment. If we do not know what its fair value is, can we use that fair value to determine the purchase price of the new asset? Yes or no? No, thank you, Mr. Mbazini. Quite correct. Thank you, Enrique. No, then we can't use it, ladies and gentlemen. And in that circumstances, IAS 16 says that if you do not know what the fair value of the old asset is, the one that you are going to give up, then you should use the fair value of the new asset as its purchase price instead. Right. So in that case, so that is one of the exceptions. One of the exceptions. If the fair value of the old asset that you are giving up is not known whatsoever, then you have to use the fair value of the new asset to determine its purchase price. Then there's a second exception, ladies and gentlemen, and that is where they say if and I'm going to use the term or the words that they use in IAS 16 first, and then we will discuss what it means, because it sounds quite complicated, but it isn't really. They say if the fair value of the new asset is more clearly evident. That's the words they use in IAS 16. If the fair value of the asset that is going to be acquired, the new asset, is more clearly evident than the fair value of the asset being given up, then also you should rather use the fair value of the new asset that you are acquiring instead as your purchase price. So those are the two exceptions. Either where you don't know the fair value of the asset being given up at all, or where the fair value of the asset that you are acquiring is more clearly evident than the fair value of the asset that you are giving up. Now, what is meant by more clearly evident? There is an interpretation out on that, well, since about 2004 or 5 already. So, what more clearly evident means is that it can be more accurately determined. Perhaps you can just make a note of that as well, because I haven't typed it in the notes. So more clearly evident means that the fair value of the one that is more clearly evident can be more accurately determined than the fair value of the one that is less clearly evident, right? So if you are 100% certain or 95% certain of the fair value of the new asset, and you are only maybe 40 or 50% certain about the fair value of the asset that you are going to exchange, that you are going to give up, then in that case, you should also use the fair value of the asset that you are going to be acquiring to determine its purchase price. We're almost done, ladies and gentlemen. Do you have another class now or not? Because if you do, I better stop. But if you haven't, I just want to carry on for another 4 or 5 minutes. Do you have another class now? No, you haven't. Thank you, Enrique. So it's all okay if I carry on just for another 4 or 5 minutes. I just want to conclude this this argument. Now, the last exception, the other exception, ladies and gentlemen, what is the situation? And then we'll finish. What is the situation if neither one, not the one or the other fair value is known? If you are not certain about the fair value of your old asset and you are not certain about the fair value of the new asset, if both of those are either unknown, completely unknown, or very, very vague, in other words, not clearly evident whatsoever, then IAS 16 says, okay, we have to have another backdoor here. Because if you don't know what the fair value of the old asset is and you don't know what the fair value of the new asset is, how are you going to determine the purchase price of the new asset? And then IAS 16 says, ladies and gentlemen, we've got to use the carrying amount, in other words, our book value, the carrying amount or carrying value or book value of our old asset, the one that we are giving up, as an estimate of its fair value. Does that make sense? So if we don't know the fair value of the new asset or the old asset, they say we must use the carrying amount of the asset that we are giving up as an estimate of the fair value. Which means, ladies and gentlemen, we are now able to use our default method. We are able to use our default method. So we are going to determine the purchase price of the new asset that we are acquiring, but by what we pay for it. So what do we pay for it? We are paying for it by means of the fair value of the asset given up, but in this case we have to estimate the fair value by using its carrying amount. So the carrying amount becomes our estimate of its fair value, and then we use that estimate of the fair value of the old asset to determine the purchase price of the new asset, right? So if the carrying amount of that old asset of ours is 40,000 rands, right? Then we are going to say we are using that vehicle or whatever the asset is as payment of 40,000 rands, right? Because that is its carrying amount. So that is our best possible method to go and estimate, get a thumb suck, if you wish, a guesstimate, as they sometimes say, of its actual fair value. So those are the four major possibilities, ladies and gentlemen, the default method and the three so-called exceptions. Now, we are going to go through some of these examples next time. I'm not exactly sure when next time is going to be. I think it's probably going to be tomorrow's Women's Day, isn't it? It's tomorrow. Tomorrow's the 9th. It's Women's Day. So it's a public holiday. So we won't have class tomorrow. But anyway, the next time that we have class, we are going to look at all those situations that we've just discussed. But now we're going to put scenarios to it. So we're going to make it more practical. So we're going to do asset exchanges and we're going to put some values to it. We're going to go through all of those possibilities. And then once we're done with that we're almost through with our notes. There's not that much left. There is actually a lot left, but most of them are questions. So we'll carry on with our notes, but we are going to look at examples and questions during the course of the rest of the notes. So, ladies and gentlemen, let's call it a day there. Thank you once again for attending. I appreciate that. We all hope and we cross our fingers that the taxi strike will end at the end of today, and that we all have a normal rest of the week and have a lovely public holiday of Women's Day today, Women's Day tomorrow. All the lovely and special people that make up our female population. They are The salt of the earth. Right. Ladies and gentlemen, thank you so much. Have a lovely afternoon. Bye bye.